In this video, I'll tell you exactly what PITI stands for and why it's the most important mortgage term you need to know about. And we're starting right now. Hey guys, Elliot here. So if you're thinking of buying a house, there's a lot you will have to learn about mortgages, and a good mortgage loan officer will guide you through the ins and outs of not just the application process, but also what comes next. And the most important topic you will need to get familiar with is your mortgage payment and what goes into it. And it's at this point that you will hear the acronym PITI or PITI. PITI is a real estate and mortgage acronym term that stands for principal, interest, taxes, and insurance. Since they are so important, let's cover each of these four components in a bit more detail. First, we have the principal. This portion of each mortgage payment is dedicated to repayment of the original amount borrowed. This is essentially the agreed upon price of the property you bought minus your down payment. Because of the way amortized payments of a typical 30-year fixed rate mortgage are structured, the principal will make up a small percentage of your overall monthly payment in the beginning, but will grow over the years until it makes up the majority of the payment. Next, we have the interest. This is the price you pay for borrowing money and the mortgage lender's reward for taking on the risk of lending it to you. Interest is expressed as a percentage, and a typical mortgage loan will also have some fees rolled into what is the APR or annual percentage rate. This is the final rate you will pay, and it's almost always a bit higher than the base interest rate. Because of the way amortized payments of a typical 30-year fixed rate mortgage are structured, the interest is front-loaded. What that means is that it will make up a large percentage of your overall monthly payment in the beginning, but will shrink over the years until it makes up just a small portion of the payment. Next are the taxes. This refers to property taxes that are levied on most homeowners. They are used by the local government to pay for infrastructure, schools, and services like fire and police. These taxes are calculated on a per-year basis and can be paid in one lump sum by the homeowner if they have no mortgage, but if they are still paying off the home, they are typically just included as part of the monthly mortgage payment. Property taxes are determined through an assessment of your home and property, and that is typically done annually or biannually. Assessments are based on a unit called a mill, which is equal to 1/1000th of a dollar. Assessors find annual property tax liability to be multiplying three values. First, the state tax rate, then the assessment ratio, which is just a portion of the property value subject to tax, and finally, the property value itself. The top two U.S. states with the highest property tax rates are New Jersey and Illinois with 2.23% and 2.08% respectively, and the two lowest are Hawaii and Alabama with 0.32% and 0.4% respectively. There are, by the way, numerous exemptions when it comes to property taxes, such as with senior citizens, veterans, the disabled, and vulnerable or low-income property owners, so if you fall into any of the above, it's worth investigating if you may not be liable. Also, sometimes an assessment of property value is done incorrectly, and a reassessment may lower your tax rate. Finally, we have insurance, and this refers to two common types of property insurance. One is private mortgage insurance, or PMI, and regular homeowners insurance. PMI is assessed if you hold less than 20% equity in your property and is protection for your lender in case you stop paying your mortgage. PMI is waived once you reach over 20% equity, and you do have to typically apply to have that removed. Keep in mind that PMI is a feature of conventional loans, and other types either don't have it, such as a VA loan, or it's called something else, such as a mortgage insurance premium with FHA loans. Aside from PMI, you also have the homeowners insurance, and that is mandatory for as long as you hold a mortgage, the same way liability insurance is mandatory when you own and operate a vehicle. Homeowners insurance will reimburse you and your lender if the property is damaged or destroyed by a covered event, and it also often covers possessions such as furniture, appliances, and sometimes much more, depending on the policy and additional riders. Okay, there you have it, a quick tour of the main four components of a typical mortgage payment: the principal, interest, taxes, and insurance, so you will know exactly what you're paying for. As always, if you enjoy this content, please do like and subscribe, and I will see you all in the next video.